Hello, everyone, and welcome to BFW 2401, Week 2, Risk of Financial Institutions. So the way I planned this presentation is I divided the slides into two parts. The first part is 26 slides, and we will talk about the whole matrix of the bank risk. There are around 10 risks, which actually they are the subject of the whole semester. And the second part, we will talk about the interest rate risk. Why I am doing that? Because in the first part, we will just give you an introduction about those risks. We will define each risk of those 10 risks. Now, in the second part, we will talk in depth on the first risk, which is the interest rate risk. Now, just to give you an idea, when we talk about risk, bank risk, and we have to do we have to deal with them from three issues. So first of all, we want to define the risk so we know what is it. And when we know what is it, we want to see what is the impact of that risk. So how big is it? So in this case, we call it measurement. And then once we know what is it and how much is it, and what is the impact of it on our balance sheet, which is the measurement, we go to manage that risk, what we are going to do about it. So as I said, in the first part, we'll just define those risks. In the second part, we will talk about the interest rate risk, but actually we will go and do some modeling, measurement, and some management. So if you allow me now to share, I'll just share my slides and start. So this is actually the subject of today, which is the risk of financial institutions. And if I refer to this map, which is the map of my unit, our unit, then we are talking about so many risks. So we have the interest rate risk here, the liquidity risk here, the single loan risk here, portfolio risk, market risk, foreign exchange risk, capital risk, and sovereign risk. And as you can see, whether we are talking about the regulation in this part or the risk management in this part, we're also dividing the weeks according, this is each week and where we are going to study this risk. This we'll talk about it later on. Now, coming to my agenda, this is the interest rate risk. This is the actually what we are going to talk about in the first part. And this is what we are going to do in the second part. So in the second part, we'll talk about the interest rate risk. And in the first part, as I said, only measurement of those, only defining those risks. I have developed for you this actually mind mapping for all those risks. And you can look at this. And it's actually, it should be very helpful because I have here, for example, the interest rate risk. I have the market risk, credit risk, off balance sheet risk, foreign exchange risk, and so on and so forth until we reach to other risks, which is the other risk and the interaction of those risks. Now, for example, the interest rate risk, I define it here, and then I talk about some of the causes of this risk. I did the same for market risk, but all of this information actually are reflected on the slides that are coming. So I will not spend much time on it, but you can use this actually map to study and to look to the whole picture of those risks and this semester. Now, this is the interest rate risk, and I will not actually cover it and discuss it here. We will, because we are going to discuss it in the second part. Let me jump to the market risk. Now, the market risk is actually the risk that incurred when trading assets and liabilities were using the trading book. Now, somebody would say, now, what is this trading book? We have something called trading book, and we have the banking book. This is how we divide the balance sheet of any bank. Now, this market risk actually is related to the changes of the interest rate risk in the market, or the exchange rate risk, exchange rates, or the asset prices. In other words, If we are actually talking about market risk, we are talking about our holdings and investments that we are keeping it on the trading book, which means we trade it in daily basis, weekly basis. When we acquire those assets, whatever those assets, we can trade foreign exchange, we can trade currencies, we can trade equities, we can trade derivatives, we can trade bonds, stocks, and even commodities like steel, oil, all those issues. And the purpose of buying and selling those assets as actually for the sake of trade. But when I give a loan, for example, that will stay that for a housing loan for 20 years, that housing loan will stay for 20 years. When I acquire another company, or when I acquire another company, like a sister company, for example, if you look at one of the biggest banks here in this country called Public Bank. Now, Public Bank is the biggest private bank here. If they acquire a fintech company or they acquire a startup, then they acquire it to help them in their operation or to expand their growth. So the purpose of it actually to hold it, not to sell it in daily, in the next auction, but they want to keep it there. That one is called the investment book or the banking book. But for example, if a public bank acquire or buy an insurance company, small insurance company, or a small fintech company, so they will keep it for a long time. This is the way I want you to understand the difference between the trading book and the banking book, which we call it sometimes the investment book. Now, market risk can be very, very, very risky to the bank. And we have seen so many banks collapse because of this trading, because sometimes you take huge exposures. And when we take this huge exposures, you are exposed to huge losses that the bank capital cannot actually compensate these losses or buffer those losses, and end of the day, the bank collapse. We have an example here, for example, Bearing Bank. This Bearing Bank, they used to have some operations, some branch here in Singapore, and actually they were trading in the Japanese Nikkei stock market index, and they take huge exposures. The individual who was actually running this trading book make a losses of 1,460,000,000, while the bank actually total capital was 860 million. So as you can see, the losses coming from the market risk overcome the capital, and in this case, the capital couldn't buffer those losses and dropped. If you want to look at this case, you can really Google what we call the Bearing Bank, and you will see. By the way, just to explain it here, when I bring any examples and cases from the industry, those you will not be responsible about it. And this is why I'm giving this hint. Now, Bearing Bank is a case and not examinable, so you don't have to worry about it. It's just for your information. Now, let me go to the balance sheet. Look, the balance sheet here, this is the assets and liabilities, like any assets and liabilities for any normal balance sheet, we see it. But the difference here, we see something called banking book and trading book. Now, the banking books, as you can see, in the asset side, we have cash, loans, premises, and equipment. This is the fixed assets. And we receive the money from the deposits, other, liquid funds, and we have a capital. This is actually in the banking book. Now, in the trading book, here is the trade. We can go long or we can go short, and I will explain it. What do we mean by going long and short? Because we buy all those assets for the purpose of trading them, selling them in intraday trading, maybe in the next hour, maybe for 1 week, maybe expend, over that or less than that. But the purpose actually to sell them. So if I go long, actually the purpose of taking all those assets, they were in low prices now. And I think if I buy them now, the prices, we have this, a positive outlook of the market that the prices will go up. So you buy them now, you keep them. When the prices goes up, then you sell them. And this is, if you want to know more about this, actually an investment class will tell you how to take this portfolio and what is the trading strategies and all those issues. So the bank do trading strategies, but our concern here is to know what is the market risk to the bank, which is the losses of this trading. Now, this is if I go long, I buy when the price is down and sell. Now, why we can have the same thing, but going short, which means if the prices now is high and you expect the prices to drop in the future, maybe some of those bonds, commodities, foreign exchange currencies, equities, whatever, the prices are actually high and you expect the prices to go down in the future. So brokers provide their customers, and actually there is so many banks do this, huge banks do this, like huge brokers. They will provide those facilities, allow you to give you those assets, allow you to sell them now, and still a liability because you owe this broker you owe the broker all those the value of those assets you sell now. Now you wait for a long time, for some time, and the prices goes down, then you sell it and you get the difference. I will give you an example. We have here a company called Sime Darby. If Sime Darby now is selling their stock for $10 or 200 ringgits, and you think the price is actually it's underpriced, it's overpriced. So now you lend it, you buy it from your cost. The facilities will be provided by your broker, and in this case, you can sell them now for 10 ringgits. But the price is actually the real prices or the fair prices of these stocks for Sime Darby is 8 ringgits. So you wait maybe for the next auction, that next auction which you choose to take, maybe next month, next day, next week, depends on the market movement. You buy them for 8, then you give them back to your broker. So as you can see, you sell them for 10 and you buy them for 8, you make 2 ringgits out of that. You are talking about, shares, for example. You can't talk about any other stock. So this is the situation. But the purpose I want you to know about this balance sheet, that banks actually are subject to market risk, and that market risk is coming from the trading book, and this trading book changes coming because of the interest rate risk, interest rate changes, foreign exchange changes, or the volatility on the equity market. Now, let me go to the next one, which is the credit risk. Now, credit risk is the most common risk actually we have when we talk about banks, because this is the traditional activities of the banks is giving loans. Now, you can give loans or you can buy bonds or stocks from other companies as investment, and those companies actually default. So, or this customer default. So you give a huge loan, for example, for a business, and that business default. And when we say default, the definition of default is 3 issues. Either they don't pay you in time, or they don't pay you the interest, or they don't pay you the principal, or they don't pay both. So delaying the payment is defaulting. Not paying part of the interest or the principal of all are actually credit risk. So when we define, we have an interesting definition for credit risk. And when we say now about the defaulting, actually we are talking about the large downside risk. So defaulting of banks, principal, interest, or and delay of the payments. This is what we know of defaulting. But there is another interesting definition for what we call limited upside risk. So if you make an investment today, and this is different, if you make an investment, say you are a huge bank and you decided to hold for 10 million, there is an issue of bonds, and this issue of bonds, you invest $100 million in those bonds. And the issuer will give you, say, a 5% coupon. But later on, after the COVID, when the situation is improving, now the bonds with the same risk, is actually are paying 6% or 7%. You didn't lose in your investment, you still get the 5%, but that upside risk is actually you are now getting 5% while the other people in the market are getting 7% or 8%. And this is actually related to your forecasting, related to your analysis, related to your expertise, that may be one of those problems. But actually, we call this upside risk. So the upside risk focuses on the uncertain positive return. So there was a return that you expected to get, you can get more, but you actually, you still get less for your investment, and you could have achieved more if you waited a little and invested in those bonds with high coupon rates. So maybe this is just new for you, but this is the traditional we know. Okay, let me go now to the credit risk, continuing with the credit risk. So also another definition or another classification of credit risk is we have firm-specific risk and systematic credit risk. So we have firm-specific credit risk and we have systematic credit risk. And let me explain it to you here. When we talk about specific firm credit risk, it is a risk that related to that individual company. For example, if you buy bonds from Apple, Apple is the huge, a technology company. And because of this, development of the G5 and the G6 and, the competition from Samsung, from maybe newcomer to the market. So, and maybe because of bad governance inside Apple company, the company defaulting. And that actually is not related to other companies. Other companies may be good. Maybe Samsung, which is working in the same industry or other industries, is just this firm-specific credit risk is coming because of reasons or causes from that specific company. But we can also have systematic credit risk. In other words, now if there is a new technology, for example, you have a portfolio and you have that portfolio, and then that portfolio, you are investing in everything. You are investing in technologies, you are investing in oil, you are investing in tourism, you are investing in aviation, you are investing in all those things. But actually there was a drop, like what we have seen actually during the financial crisis, or what we are seeing now during the COVID. Now, if that is happening, it happens to every single person in the market. And maybe your customer is okay and have no problem, and maybe there is no firm-specific credit risk, but because of this risk in the market, that led for example, if you are giving a loan for AirAsia, for example, and now you gave that loan in 2019 before we know anything about COVID. By 2020, everything about aviation and this airline industry is dead. Everything stopped. Actually, they cannot pay the loans back. Not because AirAsia have a problem, but because actually the market is not, they cannot sell. They cannot sell their services. They cannot transfer people. They cannot fly. And this is why they cannot pay. So this is what we call systematic credit risk. Now, just one more thing before I move from this slides. When we talk about firm-specific credit risk, we can manage it. How can we manage it? With diversification. And this is what actually banks do and big financial institutions do. So when you do under very, very strict and disciplined and specific expertise, you can develop your portfolios. So actually you will have so many companies and so many investments inside your portfolio. Some companies will lose and some companies will gain. And actually there is some type of correlations. For example, there is a correlation between the oil industry and the technologies. So when one goes up, some of them goes down. So you have to, that correlation is actually studied. Now, even there is some companies failing and some companies are gaining, end of the day, the bottom line of the portfolio is still making profits. And this is what we mean by diversification. We don't look at the specific company, but we look at the return of the portfolio, which means end of the day, our portfolio is not affected. Yes, there is companies losing and gaining, but our portfolio is okay. Now, when we talk about systematic credit risk, as you can see, everybody is failing inside the portfolio, which means you cannot diversify, you cannot solve this problem. So this is actually all about this slide. You can look at this this issue, this example, for example, and it's actually says what we are saying now. Let me go to the continue with the credit risk. Now, let's talk about the measurement of credit risk. Just a little measurements. We have, when we go to credit risk in week 7 and 8, we'll talk about so many things. This is just very specific. So we have what we call, as I told you, the defaulting can come from late payment. And to tell you, in this country, I think in Bank Nigara, they report, you can see the reports for the whole banking system. They have two categories, the Islamic banks and for the conventional banks. Now, they will tell you if it is one, they expect the NPL, non-performing loans. And let me explain what do we mean by non-performing loans. Non-performing loans, NPL. That means if you are, for example, taking a housing loan or a business loan or a car loan, and you are late in your payments for 3 months or 90 days, then in this case, you are defaulting. I think in this country, it's 1.5%. And as you can see, this is just for the Australian banks. Most of the defaulting, and we can explain it according to this data, was in 2009, 2008. And this is actually the time of the financial crisis. Now, but the other type of risk is the bad debt. And the bad debt is actually when there is a loan, a huge business loan or personal loans or housing loans, and the bank goes with the customer to the court, and there is a clear case that this loan is not going to be paid. So in this case, it will be a bad debt, and in this case, you have to write it off. So this is also another measurement of credit risk. We are not measuring actually, but this is just 2 examples brought in the chapter, and I want you to look at it while we are talking about here. Just to give you an explanation here, don't worry about this. In 1991, actually there was restructuring for all those loans. This is Australian data. And actually, this is why they wrote so much loans that given during the 1980 to the 1989, and then they write it all off and retire it here in 1991. You can also look here in 2008, there was another issue, which is, it looks like here, the NPL or the bad debt was also written here. So this is 2 issues. I also taken simulation data, and you can see this is for loan reserves. This is another major. Loan reserve means it's not a delay in the payments. It's not a write-off. It's only the provision. When you have a provision and you expect some type of losses, so end of the year, the auditors and the bank and prudential, thinking of running the bank, to be very prudent in this issue, you have to make what we call loan reserves. And the loan reserves means you don't write it off, but you expect that there will be some problems. So you want to take consideration from now. And this is why we consider it as a major, what we call a measure of credit risk. So if you see a bank with huge loan loss reserves, that means their actually loans are not okay. If you see also a bank with high NPL is a problem. High bad debt is clear, but I mean the loan reserve indication of expected losses in loans. Now let me go continue with the off-balance sheet risk. Maybe this is one of the issues that is new for you. And the off-balance sheet is actually these operations banks do, but they don't show the balance sheet. They are commitment, they are contingent liabilities of contracts they do. They go in a very huge contracts and derivatives that is not matured yet and will materialize later on. So in this case, it's contingent liabilities. As of now, you cannot see it in the balance sheet, but later on you can see it. Banks gave guarantees, bank open or LCs, what you call letter of credits, and we will talk about it later on. Don't worry about it. It's just I want to tell you, bank provide guarantees to others. When you provide a guarantee for 50 million or 100 million now for a customer because he's going to take some contracts with the government and they needed that guarantee, the bank will issue the guarantee to their customers and the customer can give it to the government if they are talking, if this customer as a contractor with the government taking big project, yes, they can take it, but actually in the bank, they didn't pay money and it's just a piece of paper. Okay, now it can be electronic, liability or electronic commitment, but end of the day, it is not actually a payment, but it can be a problem in the future if the customer or this contractor who is a customer of a bank default with a third party, which is the government or any other party, then that third party will come and ask the bank to pay. So right as of now, when I write the guarantee, for example, I have nothing to worry about, but actually it is under the table there. There is a liability that could happen in the future. This is what we call off-balance sheet. Now, off-balance sheet can take so many shapes. We can talk about, as I told you, guarantees, letter of credit. We can talk about derivative contracts. We can talk about so many things banks do, and it doesn't show in the balance sheet, but it's actually a contingent payments. This is what we call it, and I have defined here letter of credit, loan commitment, derivative, positions. Sometimes if you need to read, if you need to expand your understanding, please consult the book. And the book will give you more information about it. Now here we talk about speculative activities using off-balance sheet create considerable risk. Now when we talk about speculative liabilities, just to make it easier for you, it is this trading on derivatives and speculation. So we can speculate in derivatives, not hedging, and we will talk about this in the future. We just, speculate on the prices of anything, and we can make contracts. Now, foreign exchange contract is another good example. And actually, the definition of the foreign exchange risk is the risk that changes in the exchange rate by negatively affect the value of financial institution assets or liabilities. This is an example. If you purchase a government treasury bond from a foreign country, if the foreign country depreciates the value of the assets in the local currency, the value of the assets will drop in the local currency, which means if we know by now huge, for example, investments in the US for Japanese market, for example, you buy from Japanese bond or American bonds, and while the price of if you are here in Malaysia, the rate now is 4 ringgit 25 as of today equals $1. Now, when you buy it, that is actually your investment. But if the dollar depreciates and your currency and for example, the ringgit becomes 4 or 3, $1 is 3 or 4 instead 4.25 or 4.50, then in this case, actually, the value of the dollars that invested in those bonds in the US, when you convert them to ringgits, actually that is the investment in the local currency will drop, so it will be less ringgits, in other words. So returns on foreign and domestic investments are not perfectly correlated. Therefore, the increase in return of the local currency for your deposits may be more than the increase of your foreign currency returns because of the foreign exchange problem. Now, foreign exchange rates may not be actually correlated, which means the changes if you are, for example, if you are making investment in Japan and you are making investment in the US, and the increase in the depreciation in the American dollars doesn't mean that your investment in the Japanese market will increase because the Japanese yen is appreciating. So this correlation between the currencies is not there, and this is why you have always a problem. We already mentioned here. So the Malaysian ringgit to the pound is actually, to the euro, excuse me, is actually different from the Malaysian ringgit to the yen. So it doesn't mean the movement will be correlated. So if you are not diversifying in a very clever way your investment in the foreign currency, then that will create a problem. But actually, this is the issue of foreign currency, which actually we are not covering deeply in this class. Just to give you an example, I have a clearer example. So here, for example, look, for example, this is the volatility. This is the volatility, which means this is actually the yen US dollar exchange rate. See how this volatility goes up and down, goes up and down. So actually investing and banks, when they invest in foreign currency, actually it's very, very risky because of this huge volatility of the currencies, of the exchange rates of different currencies. Now, let me give you this example. Maybe this will be very clear for you. If you have, if the dollar today is, assuming you are an American bank. So if the dollar, you can be Chinese bank, you can be Malaysian bank, you just change the, you can say this is ringgit or any other currency. Okay, if you have, for example, the $1, 1 American dollar equals 100 yen, and you buy 10 shares of Toyota, which is this huge automobile company in Japan. So 1 year later, there was an increase in the prices. So maybe it's 10%. So actually your investment now is 110. Okay. So the investment now is 10% more in yen, which is 110. So those 10 shares now actually equals 110. But the problem is there was a depreciation in the dollar to the yen. So your investment now, so the yen is highly depreciated. It was 10, it was 100. Now it dropped actually to 120. Also, you are gaining, and your investment is your original investment, which is 100. Now it's 110. But the bottom line, when you come and you change it to dollar, it's actually 110 over the 120, which is the new rate, which actually makes it 916. So this 916 minus your original investment of 100 give you a losses of 84. This is just a clear example of the foreign exchange risk. Now let me move to the next one. This is a very, the country of sovereign risk. We have seen it in so many places in the world. It's just when you invest in some other countries, either you give an investment, either you give loans to big companies in that country, or you actually give loans to that country government or any party inside that country, different country. And then suddenly when it comes to payments, the foreign country will prevent any transferring, any payments or any flow of foreign currency out of the country. They just freeze everything. And in this case, you cannot get your money. Of course, this is what we call it foreign risk, political risk. Sometimes we call it sovereign risk, but actually it is, it could be your customer could be okay, no problem. It's just the foreign government, because of the political reasons, economic reasons, whatever, they stop the payments. And this actually has happened. Now, I will give you an example here. As I told you, it's just it's caused by the foreign governments. By the way, foreign governments, we have had history last century where they, confiscate the assets of oil companies, foreign oil companies, banks. We have seen so many things happening over there. So actually it happens because of the foreign government, actions to either they do it for, as I told you, for economic purposes or for political reasons. So we call it sometimes country risk. You can call it sovereign risk, or you can call it political risk. There is some examples here. This is long time ago, in 1982, and this was when the Mexican peso, the problem happened at that time. In 1982, the Mexican and Brazilian governments announced debt moratorium on Western creditors, which means they stopped paying the principal and the interest. Now, those huge debt to those governments, and actually it creates significant losses for huge banks like Citigroup. Now, currently we have, I think in 1993, Enron was a huge energy company actually in the US. And actually they take a contract in India in 1993 to build what we call power plants. And when they built the power plants, there was a payments of $300 million has to be paid to Enron. But with the new government come in 1993, there was a new government in India, and I think there was this payment and that contract was actually canceled because the government of India think that the Indians can do it themselves. Now we are not questioning what Enron has done or what the Indian government has done, whatever. We are just saying this political risk or this country risk can be happened for different reasons. For basically the Indian government thought that this power plants can be built by Indians, and they are able to do it. So that actually causes the losses of around 300 million for Enron. This is an example in the book, by the way. Technology and operational risk. This is a very interesting risk. And actually, this is coming from the failure of the systems or the people. So we have too many technological, we have systems inside the bank, depends on technology. You can talk about, all the systems now is automated. And you can have huge failure. You can have hacking, you can have bad, systems where customers, accounts and data can be spoiled, stolen, whatever. Bad security, all those cybersecurity crimes, whatever. So all these things about the system, even you can provide, even sometimes you can invest huge amounts or huge capital and the following systems, but those systems, they become obsolete very fast, or you invest in the wrong technology, and this is where the losses comes. So the system, when we talk about the system and related to technology, we are talking about this automation and these huge systems which banks always build to compete. So Bank of International Settlement has defined that, and he said the technology and operational risk is actually risk that is related to the failure of internal process, people or systems from external events. Now, some of those technology and operation risk also can bring some reputational and strategic risk as operational risk. So some financial institutions also include in the operational risk this reputation and the strategic risk. Now, technology risk has seen rapid growth, especially in the following areas. We know the automation in the payment systems. We can see in the clearing houses. FinTech is a huge thing now, and we have now this huge issues of the competing from all those starts up, and the blockchain is going to do so many things. All of those actually is technological challenges that are facing banks. I don't want to talk about technologies, but we have to understand that also the banks are trying to deal with all those issues, but actually technologies, FinTech companies and startup and the blockchain technologies actually is actually one of the technological risks that banks faces. So technology innovations has technology risk. This is when we talk about you buy, invest huge amounts of technologies, and then you have this, what we call, you obtain or you take the wrong systems or systems that get obsolete very fast. So this is one of the problems. Now, we have major objectives of technological expansion. And we acquire actually technology to lower operational costs, to increase profits, or to actually penetrate and go to new markets. Now, we build also economic of scale, and maybe this is a new term for you or some of you. Economic of scale is implying that the financial institution's ability to lower its average cost of operations by expanding its output to financial services, which means they can use the same data with technologies to introduce new products. For example, I have a huge amount of information about credit cards, and I know the customer, their behavior and their defaulting behavior and this credit quality and all these issues. Now, from this credit cards, I can invent a new product like car loans or housing loans, so actually this is what we call the economic, this is the economic of scope. This is the economic of scope, which means using the same data to generate cost synergies by producing more than one output. So as I told you, you have information about credit cards, you can create out of that another type of products, and banks do that. People now collect big data, analyze big data, provide so many things when we talk about the economic of scope, which means they produce so many things from the information. Economic of scale, I think everybody knows, which is the ability to decrease your costs and actually increase your profits, because you are actually scaling, which means you are using all your fixed cost, your fixed asset capacity, and that will lead to decrease in the average cost per unit. And this is why the economical scale will actually, end of the day, decrease your cost and of course increase the bottom line, which is the profit. Now let me go to the another one, which is the liquidity risk. Now, liquidity risk is a very interesting issue and one of the most important risks in banks. When we talk about the liquidity risk, it's just the unexpected withdrawal of your deposits. To define it here, we call it, the risk that sudden surge in liability withdrawals, which means take any bank here, for example. I know in Malaysia and some other countries, central banks are very strong and they can watch for that, but it can happen in any time where you expect the withdrawals to be 7% in daily basis. And suddenly in one day, you see the withdrawing is going to 20%. Now, if you don't have enough resources, enough liquid resources, either from interbank loans or from the market or from the central bank to help you on that issue, and you default and you delay the payments or those cash withdrawals, then in this case, this 20%, as I thought, it can be 80% in a few hours, and there will be a bank run, whatever. So the liquidity risk, everything could be fine and stable. It will help. There will be a sudden surge or a sudden increase, an expected withdrawal that you cannot actually deal with, and those news will go everywhere, and you will be in a big problems. Now the liquidation, and when you do that, you have to, banks usually go and liquidate. If you are talking about bank that they will liquidate, but after some time, but also that applies also to insurance companies, that applies to mutual funds, all those financial institutions. For example, mutual funds, if there is a huge liquidation by the withdrawal of the investors, in this case, you have to sell the whole mutual funds. And when you do it fast, this is the problem. There will be something called fire sale. And the fire sale, you will have to sell in less than the market price. Why you are doing this? Because you are rushing, because you have a liquidity problem. This could also applies to banks. They can sell all these securities very fast, in few hours, or on the same day, and they can, they can sacrifice and lose huge difference between the market price and the selling price, which we call it the fire sale. That spread, that huge spread is actually the losses. Now, we have seen too many examples. In Australia, we have Bank of Victoria. During the financial crisis, Lehman Brothers was collapsed because of liquidity. This bank, actually, the Northern Rock, this is another example. You can read about it. The Northern Rock was a very good bank, and Bank of England, which is the Central Bank of England, was trying to help. This is in 2008, but they couldn't, because of this huge queuing up. This is a bank run. This is what we call a bank run, because reputation. I mean, the news just spread like fire everywhere that Northern Rock was collapsing, and everybody would come to the bank. And then, of course, the bank was collapsed, and they couldn't pay for all those people. And even with the help of the Bank of England, which is a central bank, So this is actually a liquidity problem. So liquidity problem, the bank could be in a very good shape. The financial institution can be in a very good shape. It's just because we don't hold the money inside the bank, but we invest it. And if our expectation is not right, or because of problem in the market, any panic in the market, that will lead to what we call liquidity risk. Now, we have insolvency risk. Insolvency risk is actually the capital risk. And what do we mean by the capital risk? Please understand that all banks, and this is a very, very important issue for the regulators, when they talk about tier 1 capital or total capital or tier 2 capital, and we will talk about those capital later on. What I mean is they have to have enough capital to buffer those losses. Losses from operation and credit risk and market risk and liquidity risk and off-balance sheet risk and all those type of risks, there will be losses. But that's fine. If you have enough capital, those losses will go and we can absorb those losses from the capital as long as there is enough buffer or enough capital. But if you don't have enough capital for one reason or the other, then in this case, the losses will go and will touch the depositor's money. And in this case, this is when you go bankrupt. So insolvency risk, just to take it basically, meaning that you don't have enough capital to absorb the unexpected losses. Look at this, for example, this is, so here, for example, here, if you look at this distribution, I don't know whether you are aware of those distributions. So this distribution is the distribution of losses. Now, the distribution of losses, as you can see here, until this point, we have provisions. Provisions means when we expect some losses, we make provisions. So when the losses happens, we can consume these losses. But the second part is the capital. So if I eat all of this, which is the provisions, for example, I expected high credit risk. So I'm making provisions, which is reserves for those credit risks. So, or market risk or any other risks. So I will consume this one. But when I reach to this point, which is the expected losses, and the unexpected losses come, I will start to take the capital. And I can survive actually with the losses until I reach here. When I reach here, then in this case, actually, this is actually 99% confidence. And this is the 1%. When I reach to here, then in this case, actually, I am bankrupt. So this is actually to measure capital risk. So the capital risk is you don't have enough capital to buffer the unexpected losses, and you eat all the capital and the losses continues. So in this case, you are bankrupt. Finally, we'll talk about the interactions risks, and this is a fact of life. Look, all those risks are actually, they have marginal distributions, which means if you have credit risk, actually that credit risk was created from some type of market risk. And that market risk, and so if we have a market risk, that market risk will affect actually the credit risk. And the credit risk, because nobody is paying, for example, the market is, there is a drop in the market. So the customers are affected, your customers, which your borrowers, then in this case, they cannot pay to you. Now you have a credit risk, and that credit risk led to less cash flow coming to the bank or to the financial institution. So now you have credit risk, you have a liquidity risk. And then, so market risk coming to credit risk, coming to liquidity risk, and then the off-balance sheet risk could be there. And all those risks can accumulate in a way that they eat the whole capital. So we have now capital risk. So actually, when you talk about those issues and all those risks, they are actually integrated. So banks actually do not measure one risk, but they have their own sophisticated modeling to measure the bank risk. And actually that will be the impact on the capital. I am done. And thank you very much. I hope I didn't take a long time and try to make it speed, to make it fast. So thank you very much and see you in class. Bye-bye.